Let's discuss policy loans versus policy withdrawals. Hello and welcome to the Durham Talents channel. My name is Jesse Durham. For today's quick take, we want to discuss when to take policy withdrawals and when to take policy loans. Now, we could speak to this in real generic terms before I even begin to use our infinite banking lens and look at policy loans versus policy withdrawals and just talk about withdrawals versus loans. So let's use a common example that I would use to convey this concept of what the power of uninterrupted compounding can look like while having leverageability when it comes to access to capital. Here's what I'm saying. Let's imagine that you had $25,000 in the bank, growing, compounding at 4% interest. Okay. I know banks aren't doing that, but let's just say that they could. Let's say that you had $25,000 growing and compounding somewhere in some entity at 4%. And from that entity, you wanted to use $25,000 to go out and procure something for yourself. You're going to go out and buy a car is commonly what I would say. So you go out and you buy a car. All right. So instead of withdrawing your $25,000 out of this entity, out of this bank, what if instead you let it remain earning its 4%, and let's just use a 5-year time frame, 60-month time frame. And what if instead, because of this entity, you could leverage the value that's in the entity. You could leverage that. So let's say you leveraged the value of $25,000 and you would pay 6% to be able to do so over the same time frame, the same 60 months, the same 5 years. Okay, so your $25,000 continues to grow, but because of where you put this, and this is obviously where the policy is going to come into effect in this example, but I'm still trying to speak in generic terms. But because of the value that you've created in this entity, the $25,000, let's say you could leverage that amount and you'd pay back at 6%, which would put you closer to paying back $29,000. So you'd pay about $4,000 in interest over 5 years. You would have a monthly $400+ close to $500 monthly payment that includes that 6% to pay back. But again, what if you left your $25,000 in there compounding uninterrupted over that same time frame? Well, the difference is going to be more than $1,000. If you do leave your $25,000 in growing, compounding uninterrupted, it'll create more than $30,000. And yet $28,000, $29,000 is what you would have paid to leverage the value that you had created. So yes, here's what I'm saying. Withdrawals erode your opportunity to earn uninterrupted compound interest. Although withdrawals do have their place. Okay, so let's speak plainly in terms of implementing the infinite banking concept as described in R. Nelson Nash's book, Becoming Your Own Banker. In the beginning of building a policy or a system of properly structured life insurance policies, whole life insurance, all right, with mutual companies that pay dividends. In building a policy or a system of policies, you're wanting to accumulate capital in these policies to be able to leverage and use policy loans for the banking in your life. But, all right, so policy loans in the banking of your life. But there can come a time to where policy withdrawals make sense for you to use. You might get to that passive income time of life, and you certainly may want to withdraw from your policy or your system of policies up to the cost basis that you've paid hitherto. Okay, and that just simply means the cost basis just simply means whatever the total amount of premium is that you've paid over the years. So you can withdraw from your policy tax-free because those are dollars that have already been taxed that you've paid life insurance premiums with. So you can withdraw up to the cost basis tax-free, and that can certainly make sense for you in passive income time. Now, do you have to, and could you still just continue to make policy loans and not repay those because the policy or the system of policies has gotten that much more efficient, and you're perhaps doing some profitable things with those cash flows anyway. And of course, those policies could be so efficient that they're paying their ongoing premiums just out of their own growth. So there are lots of variables when it does come to that passive income time of life where you may choose. And isn't that the beauty? That you could choose whether to take policy withdrawals because you're the banker, or you could take policy loans, or you could take a mixture. You could do policy withdrawals up to the cost basis, then switch over to policy loans and do policy loans there and just enjoy supplementing your income in a very passive way, tax-free way, because withdrawals are tax-free, policy loans are tax-free, and all the while this policy has just gotten more and more efficient over the years, and it continues to grow and produce death benefit and cash value anyway, even when you are accessing capital via policy loans in that passive income time of your life. So while in the beginning you wouldn't want to take policy withdrawals because that would take away from your principal, that would take away from the capital base that you are seeking to build. This is your warehouse of wealth. If you're implementing infinite banking, you wouldn't want to take away from the base, the principal that you are building this warehouse of wealth with. You're going to want that to continue to compound uninterrupted. But certainly when you get to that passive income time of life, having withdrawals, having policy loans at your disposal. Again, I'm saying you do what you want to do, but that is the nature of the two. You can make withdrawals up to the cost basis tax-free. You can then transition over to policy loans to supplement your income or even replace your income in that passive income or retirement. Folks like to say, but I've adopted that philosophy, like Nash says, of eradicating that from my personal vocabulary. I'll say the word because it's common, but I much prefer to look at it as the passive income time of life when we could be enjoying tax-free access to compounding capital, even in our passive income years. So I hope that this conversation has been helpful. If you would like to further it one-on-one, I would encourage you to check out my free presentation on my website and then jump right into my calendar link. Both of those are at durhamtalents.com. This has been a great pleasure for me. I do look forward to our next conversation. You have a great day. Take care.